Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
With the stock market bouncing around last week and Trump 2.0 well underway, is there a way to participate in the market gains but not lose everything you've worked for if the bottom drops out? There is. It's called an annuity, but I don't think there's a financial product that is surrounded by more confusion and misinformation than annuities. You hear great things about annuities. You hear terrible things about annuities. So how do you know what to believe? Well, that's where we come in. We help separate fact from fiction. Keep it here as we deliver the facts about annuities and what to watch out for. It's all coming up this morning. Good. What a beautiful day. I'm David Hollander, your host, and this is Protect Your Assets Radio. For those of you just joining us for the first time, welcome. People around here, you heard the jingle, they call me the Sandman. Maybe something comes up during the week. You want to know what the Sandman thinks? You can always email me a question anytime. I love your questions. Email me questions at pyaradio.com. Again, questions anytime at pyaradio.com. So, should you consider adding an annuity to your investment portfolio right now? Well, you might if the present world situation makes you maybe a little nervous, especially if you're at or near retirement right now and you don't want to work anymore. You see, there is a type of annuity that allows you to participate in different indexes of the stock market, like the S&P 500, the NASDAQ, and protect your downside if those markets drop. This is called a fixed index because those are indexes. Annuity, FIA, that's what it's called. And today we're going to talk about the types of annuities, what you need to watch out for, and put a little safety, maybe a little airbag in your car right now. That'd be nice, wouldn't it? Today I'm going to cover some five surprising ways to profit from an annuity. Now let's get started. Well, like I said, the markets came under pressure this past week. Seems like all the situations are settling in. We had the Dow off 2.4%. S&P for the week off 3.1%. Now year-to-date, we're down almost 2% on the S&P for the year, by the way. The NASDAQ's off 3.5%, down almost 6% year-to-date. The international index, remember I was talking about that last week? Well, had a good week this week, up 3.5%. Year-to-date, up almost 11%. We'll talk a little about that in a minute. Oil. Got to keep your eye on oil. Oil was down this week almost 4%, $67.05 a barrel. Bonds off this week, 0.9%. That's because the yield's coming down, and we'll cover that in a minute. The past 2 weeks have roiled geopolitical alliances between the U.S. and Europe, and one of the consequences of that is Europe has finally started to prioritize economic growth and deficit spending. And that could be more bullish for European stocks. Here's why. President Trump's discussion last week, some call it browbeating of Ukrainian President Zelensky. I don't know about you, but that SNL skit was pretty good. If you missed it, go watch it. Combined with the pause of military and intelligence assistance to the Ukrainians. God, I can say that. It's forced Europe to consider spending money on defense. And now that the EU can't rely on the U.S. as their umbrella, for the first time in 75 years, Europe's going to have to invest heavily in the military. Now, this was discussed this past week when Chancellor Merz said Germany would do, quote, whatever it takes to build up its military. Sound like pre-war? Remember that? Well, I don't because I wasn't around, but World War I, World War II, remember Germans? Beefing up again? Well, they're beefing up again. And this apparently will boost the debt to GDP ratio to 84% in the coming years. Now, that's a big deal. It's a much bigger number. So they're going to start spending 3.5% of their GDP on defense versus the current spend of 2.1%. And that's a lot. So this is going to increase spending, which will increase growth. And that is good for German and EU defense companies that support military operations, logistics surrounding those companies, service providers, and the general economy, because there will be more jobs. There'll be more money floating around. And Germany is also right now discussing a 500 billion euro 10-year infrastructure fund. And the reason this matters to you as an investor is that that's good for European stocks. Second, it is positive overall for global bond yields. And third, that is negative when it comes to the U.S. dollar. So for the first time in a pretty long while, there's a bullish case developing right now, even with the EFI up, as I discussed, almost 11% year to date, for European stocks right now. And so you might want to consider some of that for your overall portfolio. Now, what happened in the U.S.? There's a lot going on here, as you know. And this week we saw more hints that inflation is still there a little bit. And the jobs report was decent, but not great. Wages was the one highlight, which didn't cause a full meltdown because they didn't really blow up. And the market right now is priced in another Fed cut. So we were talking about 2 cuts about 2-3 weeks ago by our Fed. Now it's 3. So we're seeing potentially 3 rate cuts in 25. That's good for our stocks, but it hasn't happened yet. So this is what's keeping it floating right now. And for those of you who are investing in a diversified way, that's smart, looking at history, you should be up year to date. And we will be talking today about more ways to protect what you've got right now and to make some better interest than is out there right now. If you're looking at that, we'll talk about that specifically. Today's show is just for you. You want to keep it right here because I'm going to talk about how you can protect everything you've worked for. You've worked too hard. You don't need all this uncertainty. You don't need to enter into your retirement worrying about where your paycheck's going to come from. If you want to know what to do, well, stay tuned right here because this is the Protect Your Assets show after all. I am David Hollander, the Sandman, and we'll be right back and we'll get right into it.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman around here. And you are listening to Protect Your Assets, and with all the volatility we just saw this past week, the questions come up, where can you invest right now and protect everything you've worked so hard for when things are just so uncertain? Well, for some, annuities can be a 4-letter word, yet for others it can be a saving grace, or perhaps someplace in between. Whether you're considering an annuity, already own one, or wondering what they're all about, you want to tune in for the entire show today as I discuss 5 surprising ways to prosper from annuities. So let's start out with this first idea. Do you think interest rates are going to continue going down more this year? If the Fed is going to continue to lower rates, because it looks like they might, according to the market, well, what does that mean? What if inflation doesn't go down anymore or rises? Could they stop? Could they raise rates? Sure. I mean, all these things could happen. The answer is yes, right? Both ways could be yes, for sure. And as you know, the Fed's been talking about the fact that they're going to react based on what they're seeing. They've said both things, actually. So if you're in the stock market right now and maybe you've made some money and you've watched it just go down a little bit. I mean, I know it's gone down and it's a little painful when you see that and you're wondering, is it going to keep going? The question is, do you need to turn that into income? And when do you need to do that? And how do you do that? And how much do you do of that? That's the big question, which gets into protection. How do you protect some of that money you've made so when you need it to start cranking out income, it's there and you don't have to worry about it even though the things are bouncing around? So how do you protect yourself from loss? Well, there's one way you could do it. There's many ways. I talked about some last week, but today we're focusing on another one. Today's is the use of an annuity. And this type of annuity is linked to an index. It could be the S&P 500. It could be the NASDAQ. It could be the Dow. There's lots of different indexes. Just depends on what you want to invest in. Well, how do you do that? Well, this is the question. It's a good question. So let's start out with this. Let's say that interest rates were to go down and, well, let's look at it the other way. Let's say you have bonds and let's say that inflation doesn't go away and so the Fed has to start raising rates. What would happen to your bond portfolio that you're relying on right now, potentially to create income for you? Well, if rates rise, value of your bonds go down. The cash value, not the yield, the cash value. Why? Well, because you can get higher yields than you have right now, and that affects your price. If you don't need the principal, don't worry about it. But if interest rates were to rise anymore, the value of your bond portfolio will go down. You may say, well, how much? Again, we're thinking big theories here. How much would they go down? Well, this depends on the maturity date, when that bond ends. For every 1% rise in interest rates, what you do is you multiply that by the ending date of your bond, and that's how much you could lose in your principal. So if your bond fund has an average maturity of 10 years and rates rise 1%, then you lose potentially 10% of the cash value of your bond portfolio. All right, maybe you don't like that. You have to ask yourself that question. However, by using a type of annuity, like a fixed index annuity, you can protect that downside if that event were to occur. With this type of annuity, you can structure payments for a set number of years or even for an unknown time if you don't know how long you're going to live, which I haven't met anybody yet who knows that, unless they really do know that, right? So let's talk about short-term investments right now. A lot of people are sitting in cash right now. I just heard about a client this past week who sold half of their portfolio because they're so worried about everything. They sold half. They're sitting in cash right now. And I immediately asked the question, well, when are you going to go back in? And they got the deer in the headlights look, right? I don't know. Anyways, a lot of folks are putting in short-term investments. So I said, like what? Well, like CDs. Well, let's compare a type of an annuity called a MYGA. MYGA, M-Y-G-A, MYGA, look it up. MYGA compared to a CD, short term. Let's talk about that. CDs right now, these are through the banks typically or online. You know what I'm talking about. Let's talk about a 1-year CD. I found that the rates they're paying right now are less than a 3 or even a 5-year MYGA. Well, we'll get into that. These MYGAs typically pay more interest than even bonds with similar maturities right now. MYGAs right now are tax deferred, so as you're earning that interest each year, you won't pay tax on that income unless you want to take it out. You control that. You choose when you want to pay your taxes, not the other way around. How's that sound? Moreover, your principal is backed by the claims paying ability of that issuing company, so it's insured, it's protected. That sounds pretty good, doesn't it? Think of this as a strategy. This is a hedge against risk if that's what you're concerned about, whether it's about volatility in the stock market or interest rates fluctuating. If rates rise, you'll continue earning the same income and will get your deposit back by the end of that contract term. If interest rates fall, you're protected by locking in today's higher yields. Right now, a 3-year MYGA can get 5.35% each year for the next 3 years. No change. That's it. Simple. That's all in. No, that's net. You want to go 5 years? 5.6%. I'm talking today, March 8th, 2025. These are the rates. This will change. That's today. You might want to consider it as a market hedge if the market drops and you're in an index like, say, the S&P 500, because you won't lose any of your principal. Your principal will stay flat with what you deposited. And right now, since these rates are better than what I saw in comparable CDs, earning a little over 4%, you can lock in and protect that interest now, and you can decide when you want to pay taxes on it, except with CDs where they 1099 you at the end of every year. So that allows you to keep more and let it grow longer too. But again, this is your choice. All right, so you have to ask yourself a question this morning. If the market were to continue to drop, how much will you lose? First question. And if you lose that amount of money, how will that affect your retirement? When can you retire if you lose that kind of money? These are all really good questions. If you don't know the answers to those questions, then stop pretending. This will take 5 minutes. Pick up the phone right now. Call us, 866-PROTECT. Find out what you don't know. Protect your principal, 866-776-8328. Coming up next, it's time for our popular They Say segment, where they say when you die with an annuity, the insurance company keeps all your money. Is that true? We'll find out. You don't want to miss this one. You're listening to Protect Your Assets with David Hollander. That's me. I'm the Sandman. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
I am David Hollander. Welcome back. You are listening to Protect Your Assets this morning. And isn't that a great word right now with all the volatility, all the uncertainty going on in the world right now? Where can you turn to? Where can you invest? Well, we're talking about that today. If you'd like to be face-to-face, ask whatever question you want. You can do it. We are doing our workshops. You can check it out on our website, libertygroupllc.com, libertygroupllc.com. Click on the events tab. There is a wait list you'll see already there, but it doesn't mean you can't come. So call or register right there online, and they'll call you, and they'll get you in someplace sometime. Don't worry about it. We do these all the time, so we'll get you in. But if you want to come to something like that, check it out, libertygroupllc.com events. Well, with all the volatility right now, where can you invest? We are talking this morning about annuities, and for some, this can be a 4-letter word, yet for others, it can also be a saving grace or something that can create income for the rest of your life. Whether you've thought about an annuity, already own one, or wondering what they're all about, you want to tune into the entire show as we've been going over some surprising ways you can prosper from annuities. Last segment, I was talking about a type of annuity called a MYGA, where you could get some pretty attractive rates compared to what's out there right now today. And those are insured and protected. So if you want to know more about that, go back and listen to our podcast. Now it's time for one of our fan favorite parts of our show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice. They say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so this is the one I hear a lot about annuities. They say that if you die and you own an annuity, the insurance company keeps all your money. Is that true? Well, this is, again, where fact and fiction needs to be explained. Because when I hear somebody say just right out of the gate, I hate annuities, or I don't want an annuity. Well, why? I like to hear what they have to say. Well, I heard that you die and your insurance company keeps all the money and your kids get nothing. That is true, by the way. It can be true. If you buy a single premium immediate annuity and you set it to just your life expectancy and you die. Because what that is, it's a type of contract that you give them a sum of money. And if you're around for a really long time, you win. If you're not, and you get hit by a truck next week, or you fall down a mountain, they get nothing. Your kids get nothing. And that's not a good deal, right? So this is where this stuff comes from. Annuities are designed to leave a death benefit if you own the right type of annuity. It just depends on what you own. We just had a client retire from Kaiser, and one of the options she had was a pension. A lot of people who work for Kaiser have a pension and a 401k. She had one of these. And the pension offered her a lump sum benefit when she retired, meaning she could take that full chunk of money and put it into an IRA if she wanted to. Or she could let them keep it. And they promised to pay her a monthly income for as long as she walked planet Earth, and they were still around. That monthly income was guaranteed by them for as long as she lived. But if she died in 2 years from now, her kids get nothing, and she has a couple kids. She has a husband, too. This pension, again, is a type of an annuity. Maybe you didn't know that. These companies take that money and they go buy an annuity. That's what they do. That's how they create pensions. These have been around for years. This goes all the way back to the time of Rome, by the way. These are old contracts. Been around forever. You could understand how the family might get upset if they end up getting nothing if she were to die, if she chose that lifetime income option. Well, in this client's case that we saw recently, she had over $1 million in her Kaiser pension account. If she lived 5 years and collected that big chunk of money every year after she retired, and she died, say, after 5 years, her family would have lost out on about $750,000. It's a lot of money. So that's not ideal in any situation, right? No one knowingly wants to lose $750,000. But it was a good thing for Wanda that she called us, because by structuring her pension properly, we were able to give her access to that original $1 million principal. We were able to get her a competitive monthly benefit for as long as she could live. And if she were to die earlier by an accident or a health change happened, and there was cash value left in that policy, then her family could get a large cash payout. That again was insured and protected against volatility in the market. So if you're looking at a pension option right now, please make sure you give us a call so you know what you could do with that. Another great use for a retirement annuity that can lower your taxes. You want to pay less taxes on your distributions or on your Social Security benefit, which you know Congress is talking about right now. This is still available. It's called a QLAC. Let's say that you have to take an RMD out of your IRA because you just turned 73 this year. You don't need it. You don't want it. But you have to take it, and that will be part of your ordinary income on your tax return next year, and that will most likely increase the taxes you pay on your Social Security and your Medicare. However, there is a way to delay taking the RMD and protecting your Social Security and Medicare from higher taxes. How? It's called a QLAC, Qualified Longevity Annuity Contract. This is a special, again, another type of an annuity designed to meet specific IRS requirements so that you don't need to take your RMD on the asset in the QLAC. It's the only way you can delay legally taking an RMD from a portion of your IRA, keep those funds growing, tax-deferred longer. You can invest up to 25% of your IRA money, up to $200,000 in a QLAC. You can delay taking income payments from the QLAC as late as age 85. That means if you have $1 million IRA and you don't want to take your RMD, you could move $200,000 of that to a QLAC and defer that RMD until you turn 85. Why else might you put an annuity in an IRA? After all, they're both tax deferred. Well, you don't like market volatility. And right now, we've seen it this past week, and right now, people are worried about what's coming. Fixed index annuities offer upside potential if the market decides to go the other way, up, but also protects you if it decides to keep going down. You could pick the S&P if you like. The lowest you're going to earn if that were to drop 20% would be zero. You don't lose any of your principal. You don't lose any of what you put in there, what you've been earning all these years. You protect it. But if the market decides to finish positive this year, well, you can keep a portion of that market's upside, and this is in return for protecting against the loss on the downside. That may sound too good to be true. And many questions I hear is, how do they do this? Well, here's what you need to know. In exchange for getting the guarantee on the downside that you don't lose your principal, which, by the way, is backed by that issuing company, you give up some of the upside. How? Well, it could be something called a cap rate. Write this down, a cap, C-A-P, cap. You heard me right. That's the maximum rate of interest you would earn in that S&P 500 index if the market finished positive from the date you bought it, because these are usually point to point. Today is March 8th. You couldn't get it today, but if you got it Monday, March 10th, a year from March 10th would be your anniversary date. That's your calendar year that they mark the index. So if you buy it on Monday and the S&P 500 is at 5770, and a year from now it's at 6,300, well, you went up. That's good. But if it's at 5,400 and you went down, well, that's bad. But you didn't lose your principal. You protected it. That's what I'm talking about. Fixed index annuities offer this protection. So when we're talking about cap rates, the annuity may stipulate that the cap on the upside for the S&P is 10% per year. What does that mean? Well, if the index, say, goes up from March 10th through March 10th of next year, 10%. I'm sorry, if the index goes up 8% between March 10th and March 10th, so it's up 8% on that anniversary date, and your cap is 10, you get to keep 8. You get 100% of the 8. If the index goes up 18%, you don't keep the whole 18%, you keep 10% because that's the cap. You understand? You get capped at 10. Where does the other 8 go? Well, the insurance company keeps it. It's how they make their money. Let's say you invest in the S&P 500 linked index in an FIA, fixed index annuity right now. Trump agrees to help Zelensky, and the S&P a year from now is up 10%. Your $100,000 you invested on Monday is now worth $110,000 with a 10% cap. Then let's say the market doesn't like the tax deal that Congress passes next year, or Russia and Putin decide to do something that came out of nowhere and the market drops 20%. How much would you have? Well, if you are in the first year, you would still have your $100,000 even though the S&P dropped 20%. Let's say we're now in the second year and that 20% drop happened again, or just happened because we said the first year was positive. You'd still have your $110,000 because in the first year you were up. It's locked in. Now it drops 20% in year 2. You still have $110,000. You didn't lose a dime of your principal or the interest you made in year 1. There's also something in these called a par rate or participation rate. This determines the percentage increase in the underlying market. These are things you want to know when you look at these things. How does this work? For instance, let's say the participation rate is 70% of the S&P 500. The S&P goes up 10%, you get what? 7%. That's locked in. So you get a percentage of the upside each and every year as long as you own that contract. Do you ever wonder if your retirement will last the rest of your life? Do you ask yourself that question? If you've saved enough to have the continual income that you need to have that consistent paycheck each and every month growing at the rate of inflation or better so you can continue to live here in the Bay Area and enjoy your life. Well, if you're wondering about that, if you can enjoy that retirement lifestyle, then you should just call us because you're not alone. Call this number and find out. We're talking to you right now. 866-PROTECT. I have people. We are here live on a Saturday. 866-PROTECT to get a complimentary copy. All right, I'll give it away. My chapter 3 of my book, Protect Your Assets, gets into this in real good detail. We can PDF and email that to you now. Chapter 3 of my book goes into this in more detail. I'll give it to you now. 866-PROTECT. Keep it tuned right here because when we come back, find out about the costs associated with annuities and one mistake you don't want to make when you choose your beneficiary. It always pays to keep it right here. Let's protect your assets. We will be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to PYARadio.com where you can download or listen to our latest shows for free. Just go to PYARadio.com on your computer or mobile device when it's most convenient for you. That's PYARadio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman. And this morning you are listening to Protect Your Assets. And let's face it, after the last couple of weeks, you must be thinking about protecting what you've worked so hard for as you're watching it free fall and wondering how much farther it's going to go with all the uncertainty and craziness going on. So relevant right now, and that's what we're talking about today. How do you protect what you've worked for? How do you create income that you can never outlive? How do you re-engineer your paycheck so when you retire, that reminds me, if you missed any of today's show, then you have to go listen to our podcast. Where? Well, if you listen to Spotify, check out Protect Your Assets market segment with David Hollander. That's me. And you will find it. And if you like it, share it with a friend. Again, Protect Your Assets. That's our brand. That's our logo. That's the Sandman. Check it out. So today we're talking about another way to protect your retirement from losses due to volatility in the stock market, how to protect income so you don't have to worry about it. It's called an annuity. Annuities are gaining in popularity again because of the volatility in the market and people's need for consistent income. We had someone walk in this past week who was looking at an annuity option from Kaiser in a pension, and we started explaining to them what they were about to do. This was a big decision. And so we explained, you got to be aware of these things. There's a lot you need to know before you just go ahead and sign the papers and pull the trigger. In this situation, she could have made a big mistake. So that's why today we've been going through 5 different ways you can profit from using annuities. So let's talk about fees. Insurance companies want to make money. And so fees are in annuities, even if you don't see them. If you buy something called a variable annuity, make sure you read the prospectus before you buy it and read the fee section carefully. It's all outlined there. You'll see things like administration fees, fund fees, company fee, rider fees. If you didn't write that down, go back and listen to it and write them down and find them and look at them. Add them up and see what you need to know to make, actually, because if you're paying all those fees, what do you need to make to break even each year, right? Right. Fixed annuities is a different type of annuity, and they are typically a little bit more reasonable because the yield that you make, like I was talking earlier about that 5-year MYGA, that 5.6% is paid out each and every year. That's your net yield, even after all the fees that are in there. You still make 5.6% insured, protected for each and every year for 5 years, and it's tax deferred. So you don't pay taxes on it until you take it out. You decide when you want to do that. Now, when you buy an annuity, you will be required to name a beneficiary, so pay attention. If you name your spouse as your sole beneficiary, upon your death, your spouse will usually have the option of filing a claim to take that policy over as a spousal rollover. Now, I'm using very specific words right now for a reason. Why? Because it's not taxable if you do it that way. What? What was he talking about? Well, let's say I've been accumulating all this money in my 5.6% MYGA for the last 4 years, and now I've got a nice little chunk of change of gain in there, and I haven't paid any taxes on it. And I name my wife as my beneficiary. She has the right to do a spousal rollover. However, if I name my kids as the beneficiary, they don't have this right. And so they're going to have to pay income tax on that increase in value that I've made those few years while that was growing, once it's distributed to them as the beneficiary. If something like that is important to you, don't wait until it's too late. Make sure you understand this and you've built that into your estate plan before it's activated, right? Because things happen. And if you're worried about your son-in-law or maybe your daughter-in-law getting their hands on money that you have just given to your family or that could go to them when you die, then you need to speak to a lawyer who specializes in this so they can design a plan that works for you and your family. There's nothing wrong with that. You know, we do that. We're attorneys. We're financial advisors. We are CPAs. We do tax returns. We're doing them right now. And if any of this information is helpful to you and you want to get a second opinion at no cost, well, you can do that right now. You're listening to our show. Pick it up. 866-PROTECT. 866-PROTECT. 866-PROTECT right now. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. Executive producer, network manager Kevin Renfer. And, of course, all my fabulous producers back there, Raph, Dylan, Nick. Thanks, guys, because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.